interesting, this trick that I've shown you with acceptance is going to help you tremendously to start identifying market structure shift points correctly, avoiding the ones that don't work, because this is just very black and white evidence. It's either going to provide you with acceptance or it's not going to give you acceptance. And if it's not going to give you acceptance, then that's going to be a liquidity grab. And the only way to differentiate between a liquidity grab and a shift point is by following the rules that I've outlined in this video with a lot of precision. In this video, you're going to learn how to catch trades like this ahead of time using market structure principles that you've never seen before. Just like I'm doing over here, waiting for areas like this, 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 and this. You will learn everything you need to know about market structure shifts, why the ones you use don't work, and everything you will ever need to make the market structure shift principle work for you. The missing piece to your market structure shifts and why they don't work for you is primarily the similarities between a market structure shift, such as this over here represents, and a liquidity grab. So if we draw this, you can see that this looks fairly similar, but this is a liquidity grab and it is not a market structure shift. As you can see, as market structure doesn't hold and we don't get that new leg up higher confirming the direction of the trend. Now, don't worry about it. It has an easy fix, and it's called acceptance, which is a key concept that you will need to understand in order to make, once again, the market structure shift work. So acceptance is the fact that we get multiple candles closing beyond the swing. If we do not get it, and once again we're going to be getting into a lot more detail in a second here, then you don't have a shift, and you need to be careful when looking to trade structure such as potential fair value gaps or POIs that may rest in the expansion leg that you see over here. It is fairly important to keep in mind that you need candles, and once again this is dependent on the time frame that you're using. So let's imagine this right here is a 1 hour leg that you're seeing, okay, in red, and you're looking for market structure. You understand that we have a shift here, and the only way that you're going to confirm that this shift is valid for the market to push higher is acceptance, as we said, because we could get a rate of the high and a rejection lower, or we can get acceptance. In order to see that, all we need to do is see multiple candles closing above the swing point that is being shifted in the market structure, as we can see over here. Now, if you are able to see that, then yes, you can look for POIs, areas of interest, naked wicks, fair value gaps within the expansion leg, which is obviously clearly denoted here, that will allow you for trades in the direction. What many people don't know is that if you consider this a market structure shift, where we just get one candle or just a wick above the shift point that you're looking for, then you're gonna fail. And this is why so many people get it wrong at the POIs. Let's imagine the following example. You are looking at a POI for confirmation, which is very good to do, as one can never know which POI is gonna work. So you're then patiently waiting for your POI. You get the market pushing into the area. The market then provides whatever it is that you use as a shift in market structure, but you're very quick to rush, right? And you take whatever candle or wick closes below the shift point. In this case, that would be there, and you take that and try to take the short position immediately, right? And I know that sounds confusing. Let's rewind that for a bit. So you're waiting at your POI, you get your shift, but you're very quick to pull the trigger. Why? Because you're not waiting for acceptance. The more time the market spends below your shift point, the better for your trade it's going to be. It's going to improve your probability and it's going to boost it. Now, here's the important thing. Many people will take a single candle closure below the shift point. Let's say this is your average bearish candle, like this, closing below the shift point once again over here, right? And what you will see happen more often than not is that, yes, you're going to get that retracement higher, but what's essentially going to happen is that liquidity is being collected and the market is going to keep on moving higher, right? I am sure that that has happened to you. It has certainly happened to me before. So the way to avoid it, and let's now look for a bullish example here. So let's get, see over here, let's get rid of this. Let's now draw the correct way of dealing with this situation, right? So this is your bullish POI. The market is moving into your area. Ideally, you want it to move sharply, but that's for another video, and that has its statistics behind it. But nonetheless, instead of be quick to pull the trigger and place your limit order here to go long at a POI within the POI, what you're going to do next time is, as soon as your market structure shifts appear, you're going to wait for 2 or more consecutive candles to close above the shift point. Once again, this being the shift point. What you're going to do is wait for 2 or more consecutive candles to close above the shift point. If you get that, then the probability of this shift here actually being right in terms of direction is gonna increase by a lot, because once again, this scenario here could very well a liquidity grab to move lower, unless what? Unless you get multiple candles closing above the shift point, 2 at least. If you get that, you're considering this acceptance, you're considering your shift to be valid, and you can proceed to trade the POI as you wish, with the expectations that you had in mind that the market is indeed going to be turning and moving into your direction. It is essential that you understand the difference between a liquidity grab and a market structure shift. Otherwise, once again, guys, you're going to be getting stopped out more often than not. The only difference, and this is the key, guys, between a market structure shift and a liquidity grab is the fact that we see acceptance above the swing point. And I don't see this being talked anywhere else, and you need to make sure that you're paying attention to this. You are going to skip many trades, and guys, sometimes you will be waiting for 2 or more candles above the shift point, and the market is just going to run without you. But that's the price that you will pay in order to avoid so many trades that are just simply going to immediately liquidate you out of the position. So keep in mind that the main difference between a liquidity grab and a market structure shift is acceptance. Keep that in mind. Write that down in your journal, whatever you're using to progress in your journey. But it is of utmost importance that you understand the difference between a liquidity grab and a market structure shift, because they look fairly similar, and one can never know, hey, are we gonna just purge the high and continue lower, or are we just gonna purge the high and run higher? And the way to identify that is by waiting for acceptance. Once again, acceptance being described as 2 or more consecutive candles closing above or below the swing point or shift point that you're waiting for. We're going to be getting into chart examples right now. This is USDCAD on the 4-hour time frame, and we're going to be applying the concept of acceptance that we just learned to the charts. So once again, guys, we can all agree that at the time of this delivery, the market was consistently moving higher. But once we reach this point, which is a major swing point in the market, we can see that something else happens, right? We get a change. This right here is a change. Now, why is this a change? It's rather simple to see. You can see that we do close below the most recent structure point, bullish one, and we accept below it. Now, why do we accept below it and should not be seen as a liquidity grab? It is quite simple. We zoom in, we can see multiple candles, 1, 2, 3, 4, 5 consecutive 4-hour candles closing below the most recent market structure shift point. So what does that indicate to you? That indicates to you that if then the market decides to push back higher, it's only doing so to rebalance to then go lower, as we can see over here. Now, where do you want to short? Once again, I would always advise you wait for discount, which is to say you're going to fib the leg from low to high, and you're going to wait for the 50% POI or higher. Now, where is objectively the best area to short? I've talked about this numerous times as well. If we look at this market, it's quite easy to understand that we have a lackluster of lows, which represent multiple breaker blocks, right? We have imbalance to the right of it, which makes for the breaker to be valid. Otherwise, I don't consider breakers. And there is more than enough naked wicks here to lean on to be looking for an entry. You can use the last pause the market makes before the break lower, which is this bullish order block, as an entry point. And where are you going to be placing your stop? You're not going to place it above the swing for multiple reasons. Once again, liquidity is resting beyond this high. It is quite easily for the market to push through the swing point and then carry on lower. And if it's going to push through where you have your stop loss, it's more than likely going to go for the swing point next, and this could happen next. So you don't want to see that happen for psychological reasons. That is why I always look for thrust candles that close beyond levels for me to place my stop loss above in this case, because this is a bearish position. If we look at this closely, my stop loss was kept above the thrust, and the target was the most recent market structure shift point, because if I'm right that this is going to be a shift and we're going to now head lower after this retracement, then this should continue to happen. And what happens below the swing is not for me to determine, because once again, there's only two options that we're going to see. It's going to repeat. It's either going to accept below the swing and close below it for one or two more candles, for two or more candles. As you can see here, 1 and 2, we get acceptance. You don't get that big pullback. I would have been looking to short once again over here at the breaker if it was naked, and then would have expected this to happen. But as I said before, sometimes the market is just gonna run without you. And that is how you apply market structure shifts. I don't want to see anyone taking trades just because we have a tiny wick below a shift point and we move back up. Because what's going to happen more often than not is this, and you're going to get stopped out. So be careful with what shift points you're using. This trick that I've shown you with acceptance is going to help you tremendously to start identifying market structure shift points correctly, avoiding the ones that don't work, because this is just very black and white evidence. It's either going to provide you with acceptance or it's not going to give you acceptance. And if it's not going to give you acceptance, then that's going to be a liquidity grab. And the only way to differentiate between a liquidity grab and a shift point is by following the rules that I've outlined in this video with a lot of precision. Very, very crucial. Let's now carry on to use the yen rather quickly. Let's see over here. This is a recent trade that I'm in using the very much same principle. We have the internal structure resting over here. We can see that we accept below it for multiple candles. So you know that if the market then is going to push up and it's going to push into the breaker once again, because it's always your best bet, you can see a pattern starting to emerge here. It's rather simple to see. You have a breaker block here, right? You have a thrust candle there. Once again, we're not placing our stop losses above swings. That is just stupid. Sorry if your educator is telling you to place your stop losses above and below swings. That's just not the right thing to do. You risk on getting slipped hard, because aggressive moves tend to happen above and below major swings. And you can see once again this occurrence many times where you just get your stop loss taken, and there we go, right into the other direction as you anticipated. So in order to avoid that, you're going to be placing your stop losses above thrust candles. Once again, wide ranging candles such as this one is, that close beyond levels. This is the same principle, guys. You have multiple lows stacked here. You know that there's going to be sellers stepping in as the market runs here, especially with the acceptance that we've seen below the market structure shift point. So when the market moves up, instead of being scared, you want to see it move up aggressively. Once again, it is the drifting into the entry that you want to be afraid of, not the strong and decisive move, because this is going to just entice more traders to go long. And what are we going to do with them? We're going to take them to the other side. Now I'm aiming for this low, although I am happily taking profits along the way at obvious points. As an example here, this is an obvious point where the market could find a bid at and move higher and take me out. It can easily happen. The next point at which I would consider that possible would be below this low. It's not relatively too deep, but it is deep enough for the market to grab fuel below it and to see it move higher. More than likely, here is the major pool that I will be looking to target, and for other reasons such as the Asian delivery model that I've taught now for years, that's been sitting on my channel for years as well, that you can look to trade. Hopefully this video was useful, and I'll catch you on in the next one.